Now, Bryce, the other big bucket of news that you've been missing while you've been on your holiday is earnings season in the United States is in full swing.
Full swing. We've got Q1 results coming out, so we're going to look at 3 key lessons.
Now, we haven't really had it in Australia because most companies report half yearly. We've had some quarterly results, but really the focus of this is what are we learning out of the US? And learning number one, inflation has not gone away.
No.
I mean, not surprising given how we started this show talking about interest rates and all of that. But here's just some of the company highlights that sort of point to it. And I guess some of the contributing factors. So UPS, the delivery company, called out rising gas prices and they've brought back fuel surcharges for deliveries. And that oil price story is going to be an important one for inflation with ongoing conflict in the Middle East.
Big time.
But that UPS called it out. PepsiCo reported that inflation is still all throughout their pipeline. Chipotle reported a wage increase and higher tech costs to support new restaurant software. The wage story is going to be an important story in Australia and in the US. Ford reported higher than expected cost in their EV division, meaning they lost more money than they thought they would in that space. They thought they were going to lose money. They lost more money. JB Hunt, a company that isn't as well known, but an important one for this story, a trucking company, had this to say about the economic backdrop. We continue to face inflationary cost pressures despite also facing deflationary pricing pressures.
That's tough.
That's tough.
That is very tough.
Yeah.
So we'll have to keep an eye on this one, but it's like that.
It's going to take time, I think is the story. Learning number 2.
Yeah.
The smaller tech names are back.
How small?
Still massive. But not the giant Magnificent 7.
No.
These are the tech names that had a massive run up in 2021 and then got smashed in 2022 and 2023, and they were doing layoffs. Their share prices were falling 80 or 90%. People were wondering if there was going to be bankruptcies. To their credit, there weren't a lot of bankruptcies. Also, to their credit, it seems like a lot of them doubled down on what worked and cut a lot of fat around things that didn't work.
Yeah.
You know, the classic example for me is Spotify spent about $2 billion on podcasts.
Yeah.
And they just said, this is a losing bet.
Yeah.
Cut that. Refocus on what works. So 2 examples that illustrate this, but it is a much broader trend in a lot of these names. Honestly, side note, we're going to look back at like 2022 and kick ourselves for not buying more of like Shopify, Snap, Netflix, Spotify, like all those smaller tech names. Separate conversation. Maybe let's do a segment on that. The smaller tech names that we wish we'd bought 2 years ago.
How depressing. I mean, even Tesla. Yeah, I saw something. Yeah, Netflix has more than doubled.
Yeah. Okay. Anyway, 2 examples that I want to bring from this reporting season. First of all, Snap. Snapchat always outperforms.
You love Snap.
People always wonder who uses Snapchat
You
anymore.
do.
Well, let me tell you who uses Snapchat. 422 million people daily. That is their daily active users number, up 10% from a year ago.
Pretty phenomenal. But, this is one of those ones that I think always comes out and surprises. But their stock price hasn't done a lot since 2022.
No, but if you look at like the last 6 months, it's done well.
Yeah, but so what? So is every company in the S&P 500.
Not every company.
Very close
not
to
Boeing,
it.
not Tesla. Anyway, let me tell you more about Snap. Quarterly revenue up 20% from a year ago, up to just over $1 billion. Still not profitable, but some impressive numbers. Spotify was another one I mentioned earlier. How about these set of numbers? Monthly active users up 19% from a year ago to 615 million. Paid subscribers up 14% to 239 million. Revenue up 20% and the highest ever quarterly profit. Spotify focused on what works and they're doing well.
The story with a lot of these, and it'll continue to play out over the next couple of weeks, is these tech companies that have just laid off thousands and thousands of people. It's starting to pay dividends because their cost lines are now
Yeah.
So much reduced, so far reduced. Yeah. Anyway.
Well, speaking of paying dividends, let me get to learning number 3, which is
Yes.
AI may be expensive, but Google can still pay a
Yeah,
dividend.
first dividend ever.
First dividend ever.
Yes.
Yeah.
Yeah.
So all of the big tech players announced big increases in CapEx spending, like capital spending, and it's all because of AI. Meta, they flagged a $3 billion annualized increase in spending because of AI. So that'll get them to around $10 billion per quarter in costs. That's like total cost, not just AI,
Yeah.
but the increase in cost is driven by AI. Microsoft said capital expenditures jumped 79% from a year earlier to around $14 billion for the quarter. And Alphabet, the owner of Google, said it spent $12 billion in the quarter just on capital expenditures, soaring 91% from a year earlier. So CapEx bills are rising because of AI, and that's because they need more computing power, they need more data centers. It's an expensive enterprise. But even with this increased AI spend, one of the biggest headlines from this earnings season is that Google is paying its first dividend, 20 cents a share. But don't worry, they also are doing a $70 billion stock buyback as well.
It's crazy. These tech companies continue to amaze me. I read recently that Microsoft are apparently exploring developing their own nuclear reactors.
Yeah, I know, because of the energy requirements.
Because they are going to require
for
so
AI.
much energy for their AI.
Yeah, crazy.
Now that's a capital expenditure.
Yeah,
Imagine
yeah,
doing
yeah,
the
yeah.
budgets for that and being like, guys, we need to factor in a nuclear reactor.
Yeah.
And
Yeah. Well, honestly, like
that is crazy.
you think it's crazy, and then you stop and you say, well, these companies are bigger than most countries.
Yeah.
And they've got energy needs bigger than most countries. And then it's like, yeah, okay, well, now it's starting, I guess, to make sense that they vertically integrate a lot of things in their supply chain when they think they can do it more efficiently. And if I was an American company looking at the US electricity grid, and a lot of electricity grids are struggling with this transition to net zero, you'd probably say we might be able to do this more efficiently.
Definitely. Well, to put that into context, in 2019, Microsoft planned to open 100 data centers over the next decade. They are now building more than 100 every year and are increasing their number of data centers from 192 today to 800 in the next 4 years.
Jeez.
That is crazy.
So Microsoft experimented with an undersea data center because obviously one of the biggest challenges with data centers is keeping it cool because it's just like so many computers running, it gets hot, so the massive air conditioning bills. And so they were like, what if we put it under the water to keep it cool? And like the rate that we're building data centers, we might need to start doing that.
Yeah.
Probably not good for the reef.
We are in a crazy time at the moment. These companies are just...
What about,
so big.
what is freezing cold? Space.
Yes.
Space data centers.
Elon.
All right, before we go too deep down this rabbit hole,
anyway.
let's pause here. Let's take a break. We'll keep you up to date with what's happening in earnings season on the podcast, through our email, and on Instagram. So make sure you're subscribed. All those links are in the show notes. We're going to take a quick break here, and on the other side, we're going to be joined by Adam Dawes for another edition of Pimp My Portfolio.